I appreciate you having you here today. It's great. I know it's hard in the morning. We got about a third of our class here, but the rest will come on in. Let me just share a thought. This is from President Gordon B. Hinckley. He was quoting columnist Jenkins Lloyd-Jones when he said this. He says, anyone who imagines that bliss is normal is going to waste a lot of time running around, shouting that he's been robbed. The fact is that most pets don't drop. Most beef is tough. Most children grow up to be just people. Most successful marriages require a high degree of mutual toleration. Most jobs are more often dull than otherwise. Life is like an old-time rail journey. Delays, sidetracks, smokes, cinders and jolts, interspersed only occasionally by beautiful vistas and thrilling bursts of speed. The trick is to thank the Lord for letting you have the ride. I hope we've been commanded to thank the Lord in all things, and hopefully we'll do that. My wife and I were talking yesterday, and I made the comment, it's going to be interesting once we get to the other side to see the impact of all of the challenges that we have and how that's changed us. And I think those things that we see right now as hard and challenging and really tough, and the hardest things we've ever gone through, I think when we get to the other side, we were going to see that those were exactly the things we needed to make us to become more like our Savior. So, just interesting thoughts. So the nice thing is what you handed in yesterday was the last thing you will have to hand in. And now the final thing we hand in is the week before class is over. So the final personal financial plan. Encourage you guys to keep working on that, especially the goals section. Remember, the goals are 40% of that grade. And on your financial plan, they should be, that's where the effort should be. Today we are talking about estate planning. Let me share what's required for our personal financial plan. So, your estate planning section. What is your current estate planning strategy? So, the action plan, what strategy should you use as your asset grow? Most realize that this section is going to be pretty short. For most of you, it's going to be my assets are less than the current $5.2 million. As my size of my financial assets grow, I'll begin to implement my estate planning strategy. It includes utilize special types of trusts. So it's going to be a pretty easy one here. But it's also, you'll notice that there are certain areas that I think we need to bring a professional. And so I asked Kurt Johnson if he would come and speak to us. And Kurt has his own planning firm down in St. George. But he's been willing to come up, and the nice thing, he comes up he works his golf around our classes. So I'm very appreciative for him and his time. What I'd like to do is I'd like to start with a song. Question, what did you think about that song? Thoughts came to mind as you thought about that. Grant, what were you thinking about when you heard that song?
I want to live it up when I'm retired.
Other thoughts? Good.
I was kind of going over the general conference talk. I think it was the last general conference a year ago by President Watson. How you said the race of life and how everyone's in a hurry. And anyway, he told a story of a woman who she found out she was dying, so all of a sudden she spent more time with her grandkids, invited them over more to her house because everyone remembers that talk. So it reminded me of that.
Would we live differently if we were live like we were dying? I think we would.
I just think the ironic thing is we are dying, so we have to wait till we're really close to dying to actually start to live.
We shouldn't wait till we're really close to dying, because we're all going to die. None of us are going to get out of this world alive. We're all going to die. And so, like the song says, live like we were dying. And kind of the theme of today's
Discussion 2 is we ought to die like we were living. And we use the things that we acquire to help us to accomplish the things that are most important. So with that, we have a big hand for Kurt Johnson.
Thank you. What I think about when I hear that song, I think it was about a year and a half ago when I was given this class. My wife's younger sister had just found out that she had brain cancer and had a tumor about that size in her head. And the doctors, it was called a glioblastoma, and the doctors gave her less than 5 years to live. Happy to report, though, that it's been a year and a half, and she's gone through the chemo, and everything's clean so far. But it's interesting to watch how she has changed her life based on that information, to live like you were dying. I mean, they went to the Dancing with the Stars show. My wife got to go with her. They got to go backstage and meet all the dancers and stuff. My wife and her younger sister were both BYU ballroom dancers. And so she's been going on a lot of trips, doing a lot of things with her kids, trying to make memories, and so it's kind of interesting how it does affect you once you do know you have a limited time to live. Let's start off by talking about some of the benefits of estate planning. Is it?
Yeah. Oh, yeah,
that one? Okay. Oops. How many of you saw the game last night? Wasn't that great? And speaking about living like you're dying, my son texted me right after the game. He says, "Are we going to New York City?" So I think I might do that because that won't probably come around very often. I think it's been, 46 some odd years since BYU's been in the NIT championship or the semifinals. So let's talk about some of the benefits of estate planning. It can provide financial security for your loved ones. You can set up trusts and things where you can provide for your kids, grandkids, and even future generations if you want to. It can help simplify the administration process. And we're going to get into this a little bit later about what happens if you have a will or don't have a will and the process of that. You can potentially protect your estate from creditors. I do a lot of asset protection planning, and we do that with a trust and stuff, and so that's another advantage of doing estate planning. You can control the distribution of the assets. Let's say you have a disabled child or a minor child. You don't want to give a 16-year-old a bunch of money. You want to put some restrictions on that until they're financially stable themselves. You can reduce or eliminate estate taxes, and we're going to go through an example of that later on. You can encourage or educate younger beneficiaries. I have a lot of clients that will put in their estate planning documents incentives, where the kids have to read a certain number of books before they get a distribution, or they have to, graduate from college or something like that. So there's ways you can do that too. And feel free to ask any questions as we're going along. I like a lot of questions and discussions. So what happens if you don't have a will? Anybody? Not necessarily. It goes through a process called probate. I heard somebody say that. I see a hand over here.
Yeah, I was assuming if you're married, it goes straight. If your spouse is still alive, you go straight to that.
If you're holding title jointly, that would be correct. If it's just in your name, though, it wouldn't. It would still go through the probate process. I've actually had that happen where a husband and wife forgot to title it in joint name. They had it just in one name, and one person died, and we had to probate that asset. So you are partially correct. If you don't have any heirs, it would go to the state. But if you don't have a will, basically the state of Utah has written one for you. And it might not be the way that you want it, although it's probably what most people would do, and that's why they've done it. It's called the intestate statute, and that's the code section where you can find that. So let's go through what that intestate statute says. It says if you're married and you have separate property and you don't have any children, everything would go to your spouse after it goes through that probate process. If you have children and they're all of that same marriage, it still would all go to your spouse. But if it's a second marriage and you have children from the first marriage, half would go to the children of that first marriage and half would go to the spouse. So that's a situation where it might not be going the way you want it to go. If you're not married, if you have any children or issue, it would go to them. If you don't have any issue, it would go to your parents. If your parents aren't living, then it would go to the issue of your parents, which means your brothers and sisters. Or if you don't have any brothers and sisters, it would go to your nephews and nieces. And only if you don't have any children or any kindred at all would it go to the state of Utah, and it would go for education, which is a good thing to benefit. Any questions on that so far?
And how long does the probate process?
It depends. How's that for an answer? Most lawyers will say everything depends.
Yeah.
But typically in Utah, if it's an informal probate, it can be done within a month or less. Usually you have to do what's called a notice to creditors period. You have to give notice to the beneficiaries and that kind of stuff. Some states like Nevada don't have an informal probate process. In Nevada, California, New York, it's very costly and time consuming. In Nevada, it's typically 6 to 9 months to go through the probate process. In Utah, if you're doing a formal probate, it can take that long also. I don't do very many formal probates because usually you get waivers of notice and then it can go pretty quickly.
How much does it cost to go through the probate process, and also how much does it cost to do a will?
Good questions, and it depends. How's that for an answer? It depends on the size of the estate for the cost of the probate, because how complicated it is. And so I would say at a minimum for an informal probate, you're probably looking at somewhere between $1,500 and $3,000. If it's a formal probate, you're probably looking more like $10,000 plus. For the cost of a will, most attorneys charge anywhere from $150 to $500. For a trust, it's a little bit more, usually between $800 to $2,000, something like that.
How does Utah compare to all other states? Most states have if you don't have a will, the state has a will for you?
Yeah, yes, good question. Every state has an intestate statute. They differ in a little bit. Like in Nevada, which is a community property state, they have some different rules than we do here. As far as probate goes, the majority of states they've adopted what's called the Uniform Probate Code, and so they do have that informal probate process, but like I said, Nevada, California, and New York don't. They have their own rules and things, and so it's a lot more complicated if you live in those states. Other questions? Okay. What are some reasons to do a will? Any thoughts there?
Who will raise your children?
Very good answer, yeah. Who's going to be the guardian of your children? That's probably the hardest question when I'm talking with clients. Like in my situation, when my wife and I were sitting down to do ours, I didn't like anybody on her side of the family to raise my kids, and she didn't like anybody on my side of the family. So we had to fight over that one. Luckily, my kids are almost all grown. My youngest now is 16, so I don't have to worry about it anymore. Another reason is to name an executor or a personal representative. The name personal representative is kind of the common name. It used to be executor and executrix. Now they just lump it all together into a personal representative of the estate. Name a guardian of minor children. This simplifies the probate process because you've spelled out, who things go to and who you want it to benefit, if you're going to provide for a disabled child, those kinds of things. You can create a trust inside of a will. It's called a testamentary trust, meaning it's created upon your death. And that trust can provide for minor children, disabled children, however you want to do that. What are the requirements to do a will? How old do you think you have to be? 18. Yeah, it must be over 18. I think everybody's over 18 here, aren't they? Although you guys look pretty young. And it doesn't seem like it was that long ago that I was in your situation here. It goes by fast. You have to be of sound mind. That's always a tough question there, because I deal with the clients that are, in their 80s and 90s, and it's questionable whether they're of sound mind. What do you think the requirements to be of sound mind are? What do you have to know? You have to know who your heirs are. You have to know who your children are and grandchildren, that kind of stuff. You have to know what your assets are, and with a lot of my clients, they don't know where all their assets are. They forget things and stuff. And you have to know who you're going to leave your estate to. So it's really not that big of a requirement, but you still have to make sure you're of sound mind. Otherwise, it could be set aside. This is one that I see a lot of, is undue influence. I'll have a child bring in their parent, and they say, Mom wants to do this, this, and this. And I say, wait, I need you to leave the room. I want to talk to Mom. This is her will, her trust. You know, you can't have any undue influence.
So what happens in the case if the person's older, they haven't made a will, they don't have a sound mind? Do they just not make a will?
Yeah,
Go through
yeah. At that point, it's too late. They'd have to go through the probate process. But the undue influence is a big thing. I've had a lot of cases where that's happened, where the child comes in. Now, if the parent is going to leave it equally to the kids, I'm not so concerned about the undue influence. It's when they disinherit, you know, their brother or their sister, you know, that kind of thing. Then you really want to make sure that there's no undue influence and stuff. And it's interesting. You might have somebody bring their parent in, and they say, "Oh, this is what Mom wants. You know, I don't want anything or whatever." But you know, right before they came in, that they told her this, this, and this. You know, and it's real interesting when I get them alone, what really comes out.
So let's say you make a will like in your late 30s, and then you want to change it in your late 70s. Can you do that?
Oh, sure. You can change it any time. I had one client that would come in about once every 2 months and do an amendment. Yeah. I think she was lonely and she just wanted to talk to me, is what it came out to, because they were very minor changes and stuff. But you can. The problem is if you're getting older and you make a lot of changes at that time period, then there's a question of, are you of sound mind? You know, because you keep changing it. You know, another thing that I've seen is what's called, what's the word for it? An insane delusion. You might have a parent that has an insane delusion that they think their kids are stealing from them, and it's actually a disease. It's kind of the start of dementia and Alzheimer's, where they think their kids are stealing from them, and so they want to change their will or trust to disinherit their child when the child's not doing those kinds of things. They're actually watching out for the parent and stuff, and it's kind of interesting how that works too. It has to be properly witnessed. How many witnesses do you have to have for a will? 2 or more, exactly. Now some states, that's a requirement that changes state by state. Some states require 3. Some don't require a witness at all. All they require is a notary. So it depends on the state. And properly executed. What's a holographic will? Handwritten will. Are those valid in the state of Utah?
Yes.
Yeah, they are. Most states, I think almost all states, allow a holographic will. The requirements are that it must be completely in your own handwriting. You can't have typewritten stuff and then your own handwriting. It has to be all in your own handwriting to be valid. You need to date it at the top, sign it at the bottom, and then inside the will, you know, designate who you want as your personal representative, who you want to be the guardian for your minor children if you have any minor children. And there's no need for witnesses or a notary if it's a holographic will.
It seems to be like that can be pretty easily forged.
They can, and so they're easily challenged. That's why I usually don't recommend holographic wills unless the state's not very complicated, you know.
For most students, your state.
I was going to say, for most of you guys, you'd probably be okay just doing a holographic will at this point.
What if you have a copy of a holographic will? Does that count?
I've actually probated a copy of a holographic will. It takes a lot of, you have to have somebody that can witness that was the person's handwriting and signature and stuff. And you have to go through the court, and the court has to say, yeah, that's right. So it can be done, but it's very difficult.
Would it be good to make a copy of your will just to make sure there are duplicate copies?
I'd say you'd be better off doing multiple handwritten wills and just do it the exact same way versus copying it. That would be better. I saw another hand somewhere, I thought. Nope. Yeah, I've had to probate things that you wouldn't think were a holographic will. I mean, it was just a little piece of a napkin that says, I want my such and such thing to go to so and so, and we were able to submit that to the court and have it be a valid will.
Realize that a holographic will isn't your best bet.
Right.
But I think for most of you right now who have very little assets, we would like you to at least do this. So if you've already got a will, you can just include that in your financial plan, include that for full credit. If you don't, then I'd like to have, we need to have both you and your spouse do a holographic will. And then hopefully in about a year, you'll actually go and do a full will.
Right. I mean, doing a holographic will is better than not doing anything at all, for sure. And like I said, use only if the estate's not very complicated and it's still valid in the state of Utah. This is an example. I don't think I'll go.
Well, is it okay if I email this to everybody?
Yeah, go ahead and email how to do it. You know, basically at the top, you know, put the date, say you're of sound mind and you're over 18, list who your heirs are. That's important. You know, say I'm married, my wife's name is so-and-so, I have so many kids, you know, that kind of thing. And then spell out who you want the property to go to, if you have specific listings and things like that. And then, like I said, name who your personal representative is and that kind of thing. So we'll get through this. Okay. How do you transfer property while you're alive? Like, huh?
Title?
A title? Yeah, like if you sell a house, you sign a deed from you to whoever you're selling it to. So how does that happen upon death? You're not there to sign it over. So how does that happen? Your personal representative signs it on your behalf, and that's why the probate process is the way that we transfer the property. I don't know if have any of you guys seen LA Law? You guys are probably too young for that. So basically, probate is a court process overseeing the distribution of your estate. And a will does not avoid probate. I don't know how many times I had clients say, well, I've got a will, I don't need to go through probate. Every will has to go through probate if you have assets in your own name. So it's a Latin word meaning to prove the validity of the will. Some ways to avoid probate is joint tenancy. We talked about that if you have a husband and wife and it's held jointly, one dies, it automatically goes to the surviving joint tenant. You can have joint tenancy with, parents and children, with siblings, with a friend, whatever. And we're going to talk about some of the disadvantages of that in just a minute. Some other ways of avoiding probate, you can name a beneficiary. How many of you have a life insurance policy? Okay, you name a beneficiary there. And so that would go directly to that named beneficiary upon your death without going through any probate process. What about retirement accounts? IRAs, 401ks, Roth IRAs? Same thing, you can name a beneficiary for those and it would go directly to that person. Have you ever heard of a POD account? That means payable upon death. That's usually with bank accounts. At the bank, you can say, I want this payable on death to my grandchild or to so-and-so, and that would go directly to that named person. All they have to do is show a death certificate to the bank, and then it's paid out. And then last but not least is holding assets in trust. And we're going to talk about that in detail a little bit later. So what do you think some problems with joint tenancy are? Any thoughts there?
Maybe like if you had a deal that goes bad, they could go after like all your property.
Okay. Say you and your dad are joint tenants on a piece of property, and you get in a car wreck and get sued. Can they take that property? Yeah, they can. They can take the whole thing, even though it was your dad's property. He just puts you on there for convenience. That if he died, that it goes to you. Because you have liabilities, it's subject to the joint tenant's liabilities. The second one I've seen happen quite a bit, where you unintentionally disinherit your own kids. Usually the typical situation is you have a husband and wife, they hold title as joint tenants, husband dies, wife remarries husband number 2 and puts the title in joint tenancy, you know, and then she dies, and then he dies and leaves everything to his kids, and husband number 1 and wife number 1's kids get nothing. And I've had those kids come to me and say, you know, can't we sue them and get that money back or that property back? I go, no. I mean, because they change the title as joint tenants. There's not anything you can do unless you can prove undue influence or something like that. The joint tenancy only postpones the probate process. So, you know, husband and wife, one dies, it all goes to the surviving joint tenant, but then when the second one dies, you still have to go through the probate process. Oh, and I forgot, you have a possibility of a double probate. What happens if you're killed in a car wreck together and you held title as joint tenants? Then you have to have a double probate. So double the cost, double the time, that kind of stuff. I've actually had that happen twice in my career. One, it was a couple, they were driving from Utah to Washington, and a semi went across the freeway and it hit them head on and killed them both instantly, and we had to do a double probate there. The other one was, one died in his, you know, from an old age, and the other one was so distraught that they died right after that, and the people, nobody found him for a couple of days, and so they never knew, they couldn't tell who died first, and so we had to do a double probate. Joint tenancy creates problems when one becomes incapacitated. What happens if you hold title with you and your dad, and your dad becomes incapacitated? Unless you have a power of attorney, you know, you got a problem. And so you want to avoid that. You can lose control. I just had this happen this week, where I got a call, and they said that a father had put his daughter on as a joint tenant on a piece of property in Nevada, and the father wanted to sell the property, and the daughter said, no, I don't want you to sell the property. And because she's a joint tenant, she can stop him from selling that property, so you lose some control. Now, in the state of Utah, there's a way where you can go around that if you can prove that the father is the one that owned the property, just put the daughter on for convenience, and the daughter hasn't paid anything towards the, you know, the property taxes or things like that. Then you can still sell the property, but it has to go through a court process. So you're better off by not putting a child on as a joint tenant. Any questions?
So if you die, do you have like your assets pay off your liabilities and then the rest go?
Uh-huh.
So, okay.
Yeah. Yeah. And who do you think the first person is that gets paid? No, me, the attorney. I've had probates where there's not sufficient assets to cover the liabilities and the debts. I still get paid first. Funeral expenses are actually your first, and then administration costs are second.
So what happens to, I mean, are those debts just gone then?
Yeah, they just get wiped out. I had a lady come in this week. Her husband died, and he had racked up, you know, $30,000, $40,000 in credit card debt. All the credit card debt was just in his name alone. It wasn't in joint name. There's no assets to pay those debts, and she was all worried that they were going to come after her. And I said, no, if they were all in his name, they get wiped out. So. Another potential problem with joint tenancy is you are creating a gift tax problem, or potentially a gift tax problem. Now, gift taxes aren't as big of a deal now. You can gift $14,000 per person per year. That's the annual exclusion amount, without any reporting requirements. If you gift more than that, like if your parent puts you on as a joint tenant on their house, that's obviously going to be more than $14,000. So you've created a gift tax issue, meaning you have to file a gift tax return, and but there's probably not going to be any tax due because you have $5.25 million exemption for either lifetime or death time. So that's not as big a deal as it used to be. And we're going to talk about doing joint tenancy, some disadvantages of that with capital gains taxes when you sell a piece of property.
It seems like there's quite a few problems with joint tenancy then. Do you ever recommend that to anybody?
I do. For husband and wife, it's fine. With the one caveat that if they die together, then you have a double probate. But I have several clients that will come in and they don't want to spend the money to do the trust, so they'll just do a will and they'll hold title as joint tenants. And then when one of them passes away, then we'll do the trust at that point. Any other questions?
And I guess in community property states, you don't have to do different or?
It depends. Community property, they have what's called community property with rights of survivorship. I believe Nevada and California both have that. So as long as the title says community property with rights of survivorship, then if one spouse dies, it goes to the surviving spouse without any problem. Okay. And I forgot to tell all my jokes. I usually start off with a joke. It's probably a good time to tell a joke. My favorite one is this one. What's the difference between an attorney and a leech? A leech lets go when you're dead. Okay. Let's see. That's not the slide that I have on mine. It must be a different order. Okay, this is talking about the problems with joint tenancy and stepped-up basis. Let's suppose that you have dad buys a piece of real estate for $50,000, so that's his cost basis, and he has a trust, and he names his son as the beneficiary upon his death. So in 2012, if dad sells the house for $150,000, there's no tax consequences to the son because the son doesn't own it yet. He doesn't get it until dad dies. Dad would have to recognize $100,000 a capital gain upon the sale. 150 minus the 50 for 100,000. If instead in 2012 dad dies, the house goes down to the son gets what they call a step up in basis. It's also a step down. We've had real estate go down between 2008 and 2010. Real estate prices went way down. You could actually have a step down situation too. But in this case, let's say the value is $150,000 when dad dies. So son gets the new cost basis of the fair market value of the property of $150,000. He sells it the next day. He pays 0 capital gains tax. Okay, so that's with the trust. If instead we did it as joint tenancy, dad buys the property, adds the son as a joint tenant in 2006. If dad sells the property for $150,000, then both the son and the dad have to report half each of the capital gain of $50,000 each. If instead dad dies, son still gets the house under joint tenancy, but instead of getting a 100% step up, he only gets a half of a step up of the dad's portion, and so the son still has to pay $50,000 of capital gains tax. So that's another disadvantage of joint tenancy. You're better off having it in the dad's name and having it get that full step up in basis. Does that make sense? Okay. We've talked about ways of avoiding probate, joint tenancy, naming a beneficiary, and then holding assets in trust. And that's probably the best way to hold title is in trust, because you don't have the disadvantages of joint tenancy, but you have the advantage of avoiding probate. So what is a trust? It's basically a legal document. It's a separate legal entity like a corporation. And then the parties that are involved are the trustor, the trustee, and the beneficiaries. Now the trustor is the one that creates the trust. Sometimes it's referred to as a grantor or a settlor. They all mean the same thing. It's the person that sets up the trust. Then the trustee is the one that manages the assets of the trust. Now typically with the revocable living trust that you set up, you're going to be the trustor, you're going to be the trustee, and you're going to be the beneficiary while you're alive. And then you provide for a successor trustee if you become incapacitated or pass away. And then you provide for successor beneficiaries, which could be your kids or other heirs. It's created by a written instrument, and There's no requirement to record the trust anywhere in the state of Utah. Some states do require you to record at least a certificate of trust in the county where you're at. Utah does not require that, though. Let's talk about some of the advantages. Obviously, the first one is avoiding probate. I've had a client a couple weeks ago that came in and had 5 properties in 5 different states. If he had just a will, it would have been a nightmare. We would have had to have done a probate in all 5 states. Well, the way they call that is where they're from is you do the primary probate, and then the other states are called ancillary probates. And I've had to do ancillary probates in quite a few different states. It's a pain. Whereas with the trust, you completely avoid that by transferring the property into the trust and avoiding that. It can reduce or eliminate estate taxes, and we're going to talk about that a little bit later. It can allow for privacy. For most of my clients, that's the biggest deal. Is the trust is a private document. You know, with a will, it's filed with the court, and it becomes a public record. Anybody can see that. And what typically happens if you have a large estate that's probated, the heirs start getting calls from salesmen and the different people wanting you to spend your money on their products and stuff, and so it can be a pain. Whereas with a trust, it's completely private. You don't have that problem. And plus, because it's private, the trustor maintains complete control over the trust. It makes the estate plan very flexible. With a trust, you can do a lot of things that you can't do with a will. You know, you can say, when my child reaches a certain age, they can become the trustee. Or if I have a disabled child, you know, we can keep things in trust, like a special needs trust, where it doesn't disqualify them from any state or federal aid, but it can supplement their life with recreational things, that kind of stuff. So it's very flexible. You can put all kinds of provisions. You'd be surprised some of the things that I've seen. I had one client that said that in order for a child to get a distribution, they had to be, you know, temple worthy. They had to, you know, all those kinds of things. They had to read a certain number of books, you know, that kind of stuff. Full tithe payer, that kind of stuff. That reminds me of another joke. There was this grandfather. He was out walking with his grandson, and his grandson looked up at him and said, "Grandpa, can you make a noise like a frog?" He said, "Well, sure I can. Why do you ask?" He said, "Well, Grandma said, when you croak, we all get to go to Hawaii." Now that I'm a grandpa, it's not as funny anymore. Some other advantages of a trust: it can facilitate advanced estate planning. I deal with some clients that have, you know, $50 million in assets, and with the trust we can do a lot of creative things and save on taxes and provide for the families and that kind of stuff. It can handle complex family situations, you know, second marriages, third marriages, children from second and third marriages, and that kind of stuff.
Can I share a story?
Yeah.
My mom passed away when I was 18, and then my dad, when I was on my mission, my dad remarried, and my dad just passed away about 4 years ago. But the nice thing about the trust is he realized that, you know, we have 5 kids, actually 6 kids from your first marriage, and then 4 kids that kind of I've got stepbrothers. But what my dad wanted to do was make sure that all of the kids felt good, and so he came through and he decided what to do is he developed a trust. And my dad had this small business, construction business. And what he did is the oldest son, who had spent most of the time in the business, he gave him a quarter share, and then the other 6 kids he gave an eighth of a share. And then what he said was, you know, after he remarried, the house, he built a house for that he and my stepmom lived in. And they said once she passes away, that would go to her kids. And then he sat down and talked with each of us and told them, this is what I want, this is what I think's right. And then when my dad passed away, it wasn't a problem. There was no argument. There was no concerns, because everybody felt that, you know, this is what he wanted. He had talked to everyone one-on-one. And it just made, you know, it was because of the communication that went on, there were just no problems at all when he passed away.
And that's very important, the communication. So many times I don't know if it's the older generation or what. They want to keep everything private and don't want to disclose anything, you know. But if you can communicate beforehand, it does make it so much easier, especially if the parents are doing, you know, something unique with the distribution. Like they might be singling out one of the children as a spendthrift, and they don't think they can handle the, you know, a lump sum, and so they're saying, you know, give it to them so much per month. And if you haven't talked to the child in advance, that child's going to be upset. How come I'm being treated differently from my sibling, you know? But if you can talk about it and explain why you're doing that, it usually makes it a lot easier for that transition. A huge advantage of a trust is if you become incapacitated while you're alive, you know, you provide for a successor trustee without having to go to court and have a guardianship or conservatorship. That can be very expensive to go through that. And it's not a fun thing to go through, you know, to go to court and have doctors testify that you're incapacitated, you know, that you're not able to handle your financial affairs. And typically, the parent doesn't think that they're incapacitated, and so they're going to fight it, and then you look bad because you're bringing the action to declare them incompetent, and so they get mad. You know, if they're really not incapacitated, you're probably going to be disinherited because you brought that action. Whereas if you have the trust, it basically says if two doctors say that you're unable to manage your financial affairs, then the successor trustee can take over. And that, typically it could be the spouse could be the successor trustee, or you could have one of the kids. If it's a second marriage, typically you'd have one of the kids from the first marriage and the spouse. The second spouse be the co-trustees, that kind of thing. You can create other trust inside of the trust. I do this a lot for asset protection. What I do is it says when mom and dad die, it's going to be divided into as many equal shares as their children. Let's say there's 3 children, so you'd have 3 separate trusts that would be created for the children, and then each child can be the trustee of their own share. And by doing that, it's 100% protected from creditors or spouses or, you know, bankruptcies, that kind of stuff. So it's a great estate planning tool and asset protection tool to continue that on with a trust. I call it a sub-trust of the original family trust. Now, a trust is just an empty box unless you put things into it. So I've had to administer trusts that were done by other attorneys where they never funded the trust, and so we actually had to do a probate. Whenever I do a trust, I also do a will. It's called a pour-over will, meaning if you forget to put assets in the trust, it pours it over and puts it into the trust, but it would have to go through that probate process. So in effect, they're paying double. They're paying for the trust initially, and then they're paying for the probate process. Whereas you're better off by properly funding that trust by putting your assets into the trust. So like bank accounts, you have to go to the bank and change the account into the trust. Real estate, you would do a deed transferring the property into the trust. Stocks, you change the actual stock certificate, that kind of thing. So you want to make sure that you properly fund the trust once you set it up.
Question.
Mm-hmm.
So is that saying, it sounds like then you want to put all your assets in the trust initially and you're just the trustor.
You're the trustor and you're the trustees.
Okay, does that complicate things when you need to?
No, my dad had that same, it took me 5 years to convince my dad to do a trust after I had been practicing estate planning, because he thought he would lose some kind of control or something, but now he's had his trust for several years and it hasn't changed the way he's done business or anything.
Okay.
The key is if you buy something new, to make sure you buy it in the name of the trust so that it doesn't have to go through that probate. Because a lot of times, you know, years go by and they forget about the trust, and you know, they'll buy a piece of property and then they pass away. That one asset has to be probated then.
And all it takes in putting something in the trust name is just putting the name of the trust instead of your name?
Right, right. Well, on real estate, you have to actually record a deed from you to you as trustee of the trust. Bank accounts, they have a form you sign and title it in the trust. Now, on bank accounts, you don't have to have your check say, you know, XYZ Family Trust. It could just have your name on there, but on your monthly statement, it can have the name of the trust on there.
Cool.
Other questions? Yeah.
So as far as like, so obviously you pay to set up a trust. Would upkeep of a trust, would that be
An ongoing cost?
ongoing thing?
There's not a whole lot of ongoing costs unless you're changing your trustee or changing your beneficiaries. that kind of thing. If you're changing assets, there's no ongoing cost for that because that's just a listing of the assets of the trust. And most attorneys don't charge anything to update the assets. The Schedule A is what I call it. Other questions? Okay. Some other reasons to use a trust: you can control the distribution to minors. You know, you don't want to give a minor a bunch of money, but you can say, you know, if I pass away and I have a minor child, I want to provide for that minor child, you know, provide for his education, his health needs, you know. And then once he gets a certain age, you know, maybe give him the income from his share to get used to handling a little bit of money. And then when they get old enough, you know, give it to them outright if you want. Or for asset protection purposes, I would probably keep it in trust forever, but let them become the trustee when they become a certain age.
So with minor children, do you typically leave your assets to help with the raising of the child? So like a certain amount is given to the guardian, or is it more a trust for their education later?
That's a great question. What I typically do is I don't leave a certain dollar amount to the person that's going to raise the children. What I do is I just say that the trust funds are available to the child for health, education, maintenance, and support. So typically I want the trustee to be different from the guardian. So you have a check and balance there, because if the same person is both, you have a potential of them using the money for their own benefit, not for your child's benefit. But by having that separation, the guardian would come to the trustee and say, hey, I need you know, a couple $100s to pay for braces or whatever, and then the trustee can do that. And so that's typically what's done. By being broad enough on the language for health, education, maintenance, and support, you know, as much as needed can be used to take care of the child as they're growing up. Great question.
It's maybe unrelated to what we're talking about right now, but we talked about wills and trusts. When would you get a will versus a trust, and timing-wise, when would you start thinking about either of those?
My feeling is if you have minor children, you should have a trust. If you don't have any children and your assets aren't very complicated, then a will would suffice. But the reason I say that, if you have minor children, typically you're going to have a life insurance policy in place that if you die, you want to take care of your wife and child. And so you'd want to have a trust, though, that if you and your wife are both gone, if you don't, and the child's named as the beneficiary, it's kept in a guardianship account for that child. But as soon as they turn 18, they get the full amount of the funds, and I've seen that ruin kids. But by having the trust, you extend out when they can receive it when they're more capable. Okay. Disabled children, kind of the same thing as a minor child. You know, if you have a child that has Down syndrome or some other kind of disability, you can make provisions for them in the trust.
So what if the trustee does things the beneficiaries don't like? What happens there?
You can sue them. That's why it's real important of who you name as your trustee, because if they don't do what they're supposed to do, the beneficiaries can sue the trustee and remove them as a trustee, or sue them for mismanagement of funds. I've seen that happen. I mean, this was a ridiculous case in Las Vegas, very wealthy family. The trustee did some self-dealing and benefited himself personally, but he made the whole family several $1 million, but they still sued him because he did some self-dealing for himself. So, yeah, that's the protection, is that if the trustee's not carrying out the terms of the trust, the beneficiaries can sue them to enforce them to do that. Good question. Creditor protection, we already talked a little bit about that. Teach children financial management skills. Like I said, I've had some clients say you have to read, you know, this book, this book, this book, and make sure you understand how to handle money before you get a distribution. Generation skipping, that's not as big of a deal as it used to be. There is a tax called a generation skipping tax. If a grandparent gives money to a grandchild, that's considered a skip generation. You're skipping the children. And the exemption is the same as the gift tax exemption, which is $5.25 million. So you'd have to give more than that before you have to worry about a generation skipping tax. So that's not as big of an issue as it used to be, but we can take care of that inside of trust. I've been practicing for over 20 years, and I've got some trusts that we did years ago when the estate tax exemption was like $600,000, and one of the spouses had passed away, and we created a generation skipping trust for grandchildren. and those trusts have been going on for quite a while. And so any distribution from an exempt generation skipping trust can go down to the grandkids, estate tax-free and gift and generation skipping tax-free.
So is it, imagine that you could probably set up a trust so that it's paying out certain amounts over certain years. So with that 5.25 million, is that just the total value of the trust that's going, or is it like per year? So if you just only pay them a lesser amount per year?
No, it's a total amount of 5.25 million. So.
They would have to pay that all up front, even if you were to say, I'm only going to give them so much per year then?
Well, what you can do is you can set aside the full 5.25 in a separate trust, and then whatever that grows to would still be generation skipping tax-free, and then you could bleed it out to the grandchildren as needed without any problem. Protect assets from second spouse and second spouse's kids. I like to affectionately call that one the bimbo clause. How that works is you create a trust, husband and wife set up a trust, and then it says upon the first death, the trust splits into two shares. I call one an exemption trust share and the other one the survivor's trust share. The exemption trust share is the bimbo clause, meaning that trust becomes irrevocable. The surviving spouse cannot give those trust assets to the new spouse or the new spouse's kids. It ensures that it's going to go down to their kids. And I've done that a lot, and it comes in handy because there are a lot of second marriages. You know, I live down in St. George. There's a lot of older people and a lot of second marriages down there, so that's an important clause to have in there. The survivor's trust share, you know, the survivor can do whatever they want with that, but at least you're protecting the deceased spouse's share of the estate from the second spouse or second spouse's kids. This is one of my favorite quotes. Over and over again, the courts have said that there is nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everybody does so, rich and poor, and all do right. For nobody owes any public duty to pay more than law demands. Taxes are enforced exactions, not voluntary contributions.
That is, unless you're Mitt Romney.
I was going to say, unless you're Joe Biden, he's the one that said we need to pay more taxes. He doesn't, but he thinks we should. Okay. Before 2013, I don't know if you remember, back in December, the estate tax exemption was supposed to, in 2013, was supposed to go back to $1 million. It had been at $5 million, and it was scheduled to go back down to $1 million, and the tax rate was going to be 55% on anything above $1 million. And so, you know, at the end of last year, I was doing a lot of gifting because we weren't sure what was going to happen. We had clients that were doing major gifts to utilize the $5 million gift tax exemption because they were afraid that the estate tax exemption was going to go back down to $1 million, which would cause, you know, a lot of taxes to have to be paid. But on January 2nd of this year, they made it permanent, the $5 million, and they indexed it for inflation. So that's why it's $5.25 million for 2013, and it's going to go up every year. That's the amount that you can pass free of estate tax or free of gift tax during lifetime.
Is that permanent?
It's permanent until the next Congress changes it.
Yeah, I didn't realize that. So the slides will be, there's a mistake on the slides.
Okay.
But you said during the lifetime. So does that mean if
You can.
5 million today, but then you die and you leave 10 million, then only 250,000 is covered? Or?
Say that again?
You said during lifetime.
Yeah.
Would you explain that?
Yeah. What is, you can give $5.25 million either during lifetime or at death. So if I gave $5.25 million while I was alive and then I died with another $5 million in my estate, I'd have to pay tax on that full $5 million.
So what then is considered gifting? Is that just beneficiaries that are mentioned in your trust, or is that charitable donations also?
It's not considered charitable donations. That's a separate thing. But if you give assets to a child or grandchild or whatever, that's part of the gift tax. Now, I mentioned earlier that there's a freebie that the government's giving you. You can give up to $14,000 per person per year without touching that $5.25 million. And I've worked with some clients, you know, back again when the estate tax exemption was $600,000, and they had an estate right then of about $2 or $3 million. We were gifting, at that time it was $10,000 a year. We were gifting $10,000 of assets to their kids every year trying to reduce their estate. And so you can do that. That $14,000 per person per year is a freebie that you've got. So hit your parents up, say, Dad and Mom, I want you to reduce your estate. Give me some money. That's that annual exclusion thing. And it's just an example. It's not limited to just children or grandchildren. You can gift that $14,000 to whoever you want. And I always tell my clients, you can even gift it to me without it being subject to a gift tax.
Hey, try that out.
But they've never done that.
Give it to me.
Okay.
So here's the mistake. I didn't realize, I thought
Yeah.
this was temporary.
So in next year it's going to be 5.35 or something like that. It's based on cost of living and index for inflation.
How about the percentage? Is it still going to be 40% or is that going to be?
I didn't know. I didn't look that up. I believe that it's 35% on anything over 5.25 million.
I thought it was 40.
It might be. I can't remember.
I just didn't know. And
Yeah.
I updated his slides this morning before coming to class, and so that's why there's mistakes.
Yeah.
It's not his, those are mine.
And I'm in the middle of tax season. And I haven't had time to even think about this.
I'm appreciative that he's just coming down here.
I'm also a CPA. I do income tax returns. I do about 150 tax returns during tax season. Most of them are trust income tax returns or charitable trusts and things like that, but it's still pretty busy. So this just shows what's happened over the year. I'm sold way back when it was 600,000, the exemption, but that shows you what it's been over the last 10 or so years, which is nice that they've changed that.
So if you have a will, you don't get in as 5.25 million.
No, you do. Everybody gets it, whether you have a will or a trust. Yeah, everybody gets that. Now, 2010 was a unique year where there was no estate tax at all. That was the year I had a client that was in his 80s, and he said, "Should I jump off the cliff yet?" I go, "No, it's not worth it." But how many of you remember who George Steinbrenner was? He was the owner of the Yankees. Oh yeah, he's got a Yankee hat on. He knows who that is. He hit a home run. He died in 2010 and saved his estate about $500 million in taxes. So this is showing what the tax would have been on a $10 million estate back when the exemption was $1 million, 4.92 million. This one's wrong. It would be about 1.8 or so, something like that. Here's another quote I like. Estate taxes are not really taxes, but penalties imposed on those who neglect to plan ahead or who retain unskilled estate planning attorneys. So when you do your will and trust, you want to go to somebody that knows what they're doing. I've had to clean up other attorneys' messes where they've done these things.
This is wrong too. Sorry, my mistake.
Let's see.
Yeah, I thought it went back to.
Yeah, this is if it went back to $1 million. If it went back to $1 million, the estate tax rate was going to be 55% tax. That would be a huge burden. So, sorry about that. Okay, this is showing back when the estate tax exemption was $1 million. If you had an estate of $2.1 million and you had no trust, you had a joint tenancy, you die, $2.1 million goes to your wife. Now, when a husband and wife, for the estate tax, there's an unlimited marital deduction. So you could have an estate of $50 million, you die, it can all go to your wife without any estate taxes on that first death. On the second death, obviously you're going to be paying a huge amount of taxes, but on the first death, there's not going to be any taxes due. Then say a year later, the wife dies and she spent $100,000 of that $2.1 million. So she has $2 million left in her estate. Under that scenario, back then, $1 million of that would be taxed, and the tax on that would be roughly 55% or $605,000. The heirs would only receive 1.3 versus the 2.1, whereas if they had the trust, same situation, husband dies, we split the trust into two shares, a trust A, a trust B, or what I call an exemption and a survivor's. So the exemption or the trust A is the deceased husband's share of the estate. He has his $1 million exemption, so that's not going to be taxed, that's set aside. Then when the wife dies, her $1 million is going to be taxed, but she has her $1 million exemption. So under this scenario, the heirs get the full amount. So that's how you save on estate taxes with a trust, by splitting the trust and getting each spouse's exemption amount.
So then with this, with the current amounts, you can have those up to
10 million.
10 million estate if it goes half and half. Okay.
Correct, correct. Okay. Some other uses for trust. How am I doing on time? You said 10 after?
You've got, all right, so you've got about another 8 minutes.
Okay. I got one more joke I got to tell before I forget. There was these two buddies. They loved to play baseball, and I was thinking of George Steinbrenner and the Yankees. They made a pact with each other. They said if one of us dies, the other one's got to come back and let us know if there's baseball in heaven or not. So years go by, and the one guy dies, and he comes back to his buddy. He says, "I've got some good news and some bad news." He says, "Well, give me the good news first." He says, "Well, there's baseball in heaven." He says, "Well, what could the bad news be? You're pitching on Friday." So some other uses for trusts. There's a thing called a wealth replacement trust, or what ILIT stands for is irrevocable life insurance trust. That's where you can purchase a life insurance policy, put it into a trust, and then the proceeds of that are going to be estate tax-free and income tax-free. We usually use that for the payment of estate taxes. So in this scenario, somebody would have to have an estate over 10 million before we'd have to worry about getting life insurance to pay the taxes. That's usually the cheapest way to pay the estate taxes. Charitable gifting. I do a lot of charitable remainder trusts. That's where you have a piece of property that's highly appreciated, and the client wants to sell the property but not pay the capital gains tax. So what they do is they transfer the property into this charitable remainder trust. Then the trustee of that trust sells the property. The money comes into the charitable trust. There's no capital gains tax on that. And then that charitable trust says we'll pay a lifetime annuity to the client. And then when the client dies, whatever's left of the principal goes to the named charity, like BYU or the church or whatever. And I work a lot with LDS Philanthropies with clients that leave the church as the ultimate beneficiary. Generation skipping tax, we talked a little about that already. Valuation discounts and freezing appreciated assets. We do that with partnerships and LLCs. You can get discounts because of minority interest and lack of marketability and stuff. Again, those are for the larger estates where we're trying to reduce their estate. Grantor retained annuity trust. That's a trust where the grantor is still taxed on the income, but has transferred the property down to the kids at a discounted value. Personal residence trust, where you can put the parent's house into a trust and basically gift it to the kids over time and reduce their estate that way. We talked a little bit about special needs trusts, where you can benefit a disabled child and still not disqualify them from any state or federal aid. Medicaid is for older people that can't afford to pay for nursing home care costs. With the trust, there's ways where you can protect the parents so that they don't have to spend down all their assets to qualify for Medicaid. Some other estate planning documents that you need to be aware of are living wills. Have you heard of that term before? That's basically a document that says that you don't want to be kept alive artificially by the machines. Okay. Health care power of attorney is where you designate someone to make health care decisions for you if you're unable to. An asset power of attorney says that if you're unable to sign your name, you give someone else the power to do that. That is real important to have that. The last will and testament, or the pour-over will, and then the living trust we've already talked about. The Advanced Healthcare Directive, Utah actually combined the living will and the healthcare power of attorney into one document called a healthcare directive, where you designate someone to make healthcare decisions for you.
For your wills, you actually have to, I'd like you to go in there and read through that and sign that and include that part of your wills. So the estate planning section will be on the estate plan. You'll have another one on the wills, and it's included that is your Advanced Healthcare Directive.
Okay. And then other power, we talked about that, trust provisions. DNR, that's becoming a big thing too. That usually requires the doctor to approve that. And Utah actually has come out with a 2-page document called a physician's order. And you can go through with your doctor and say, I want this done, or I don't want this done if I'm in this situation. Do I want to go on dialysis? Do I not? That kind of thing. So that is an important thing to have too. Talked about those already. And then probate and taxes are not the same thing. Plan for both. Other considerations may turn up either tax or probate avoidance. Plan for the possibility of death while you still have minor children. And then live life fully, like the song says. Live like you're dying.
Can we have a big hand? Thank you, and I'll make sure I fix those slides.
Okay.
Appreciate you having it. Realize there's a separate PowerPoint for mine. You need to understand how you calculate estate taxes. There's a case study we have. Make sure you understand how to do that. But I appreciate you being here. We will see you on Tuesday. Thank you.